Hi, this is Gavin from Options Trading IQ, and today we're going to be looking at the long strangle option strategy. So why would traders enter a long strangle? Well, they'd enter a long strangle if they're expecting a big move in the stock but they're unsure of the direction. You can see here in the payoff diagram, the trade's going to be profitable if it makes a big move to the upside or a big move to the downside. And if it stays range bound, the stock stays in the middle between sort of 41 and about 58, it's going to not be profitable. This is at expiry, of course. Ideally, traders are also going to see an increase in implied volatility, and if that occurs, traders can close the position early for a profit. So how do you set up a long strangle? Well, it's pretty simple. You buy an out of the money call and an out of the money put. So in this example on the left, we've got a stock trading at around 50. The trader goes in and buys a $55 call and a $45 put. The further out that you go from the strike price or the stock price, the less the trade is going to cost, but the bigger move that you need in the stock price. So you can see here two different examples, one on the left that has the strike prices placed further out at 40 and 60, costs a lot less. The maximum at risk in the trade is $200, whereas our original trade on the right with the strikes at 45 and 55 costs $400. So trade on the left costs less, but you're going to need a bigger move in the stock in order to move into the profit zone at expiry. So what are the characteristics of a long strangle? Well, the maximum loss is limited to the premium that you pay. So here $400, that's what we pay when we place the trade. That's the maximum that we can lose. So that's nice in that it's a defined risk trade. You know when you put on the trade exactly the maximum that you can lose. The maximum potential gain is unlimited on the upside, so theoretically the stock could go to infinity. You're just going to continue to make money, and you're going to continue to make money on the downside all the way down to zero. The break-even points are equal to the call strike plus the premium paid. So here we can see that the break-even's around 58, so this trade probably cost it would be around 59, because it cost $400, so 55 plus 4 would be 59, that's our break-even price. And on the downside, it would be the put strike minus the premium paid, so the 45 less $4 that it cost, the break-even on the downside would be 41. Closing early for a profit is possible, as I mentioned before. As you can see here, the blue line on the graph indicates the profit or loss at expiry, so that's our typical looking long strangle trade. Now the purple line that you see there indicates the profit or loss 1 week after trade entry. Now that's assuming that all other factors are the same, so the stock price hasn't moved, etc., etc. So you can see that after 1 week, the required price move in order to make a profit is much less. So ideally you want to put the trade on and then you want to see the big move happen straight away. You don't want to be left holding the trade for too long because time decay is going to gradually eat away at the position. And in this case, an increase in implied volatility would help the trade even more. So 1 week into the trade, let's say you have a 5% down move, you're looking at on the graph there about $1,000 in profit on capital at risk of just over 4,000. Now if implied volatility also increased, that profit could be a lot more than $1,000, could be $1,500 or $1,200, something like that. So the Greeks, really important when trading options to know about the Greeks. So the Greeks of a long strangle, the delta, typically going to be neutral for a long strangle trade. So starts out delta neutral, however once the trade will start to take on an additional directional exposure once the stock price starts to move. So if the stock price moves up, you're going to continue to pick up delta on the upside. Same if it goes on the downside, you're going to move away from that neutral position. VEGA, so the sign here would be positive, so it's a positive VEGA trade. And positive VEGA means an increase in implied volatility will benefit the trade, and a decrease in implied volatility will hurt it. So as we just said, we want implied volatility to go up after we place the trade. So a good time to be putting them on is when implied volatility is low and you're expecting it to rise. THETA, or time decay as some people say, is negative. So negative theta means that the value of the position will erode as each day passes. Traders need the stock to move before the effects of time decay become too severe. So a little bit more on VEGA. Going further out of the money reduces the exposure to changes in implied volatility. So those two examples we looked at earlier, one where we had the strikes closer in and then we moved further out, the VEGA exposure on the one that's further out is going to be lower. So you can see here a couple of examples. We've got two 3-month duration trades. One of them's 8.5% out of the money, so the strikes are placed, call strike is 8.5% above the stock price, the put strike is 8.5% below the stock price. You can see for that one the VEGA exposure is 319. If we bring those strikes in to be only 4% away from the money, you can see that the VEGA shoots up to 429. Also, going further out in time increases the exposure to changes in implied volatility. So the second two lines there, we've gone out to 12 months. We've gone the same two distances away, 8.5% and 4%, and you can see that the VEGA exposure is much higher at 801 and 859, so over double basically. If we bring those strikes in to be only 4% away from the stock price, you can see that the VEGA shoots up to 429. Also, going further out in time increases the exposure to changes in implied volatility. So the second two lines there, we've got the same trades in terms of distance away from the stock price, but we've gone out to 12 months in duration, and you can see a big jump in the VEGA exposure, so 801 and 859 there, so around double or a bit more. A little bit more on theta. Similar examples here, going further out of the money reduces the effects of time decay, so placing the trade further away, you can see the top two lines there, the 8.5% away is only suffering time decay of 33 or theta of negative 33, and the 4% is negative 45. And similar, going further out in time also reduces the effects of time decay, so we've dropped from 33 to 22 and from 45 to 27. So the costs of these trades, going further out of the money reduces the capital at risk and the cost that you have to put into the trade. So here the 3-month examples are 8.5% away, but half the price of going 4% away, so 2,600 as opposed to 5,200. If we go out to 12 months, so going out further in time, it increases the capital at risk. So you're paying for that time premium. It also gives the trade longer to work, so you need to pay a little bit more for that. Here we've jumped up to 10,400 and 14,200, so very expensive trades. That may be prohibitive for some people, depending on what instrument you're trading. A little bit more on the delta. So all option strikes have different delta values. Due to implied volatility skew, puts generally have a higher relative delta than calls. So here we can see that even though the strikes are placed an equal distance from the stock price of 200, the position is not delta neutral. So assuming SPY was trading at 200, we've got a March 190 put and a March 210 call, both $10 out of the money, and the delta of the put is negative 329. The delta of the call is 310. So that for 10 contracts, that gives us a net delta of negative 19. So even though we've placed the strikes perfectly equal away from the stock price, we've actually got a negative delta on the trade. If you wanted to get perfectly delta neutral, with this example, you could go ahead and buy 19 shares of SPY and the position would then become delta neutral. Note, of course, that it will not stay delta neutral for long. Okay, so that's how you get delta neutral. If you're suffering from the effects of the volatility skew and you want a perfectly neutral trade, you can just pick up some stock to neutralize that delta. Okay, thanks for watching. I hope you enjoyed this video. And remember to head over to optionstradingiq.com for more great articles and videos.